Hi, I'm Tim. I'm the economic forecaster, and this is a brief market summary for the week ending May 29th of 2009. You might have heard me say before that the bond market is the pulse of the real economy. Bond traders seem to be more in tune with what's going on with the real economy and the things that are going on within it, versus the stock market, which is really nothing short of a giant global casino. Now, it used to be that people bought stock for the dividends that they paid, and this is how you would make your money. You hold your stock over a certain period of years, then they would sell it, and they would cash out any capital gains that they might have accumulated. But things are very different today. The stock market is nothing short of a giant Ponzi scheme. Basically, people are trying to make money by buying low and selling high tomorrow. Now, there's nothing wrong with that except for the fact that there's been a tremendous amount of manipulation that has been taking place in the stock markets. And there's also been a lot of the securities laws that have not been adhered to. So that's why I feel that the bond market is a much more even platform to base what's really going on with the economy. And the stock market couldn't be further from the truth as far as a reflection of our economy or the things that are going on within it. Now, the Treasury bond market this week was very volatile. The $100 billion of debt that was auctioned off this week was a little hard for the markets to swallow. The rates on the 10-year hit 3.75% yesterday before pulling back. It was a little bit of a Thelma and Louise moment there. We could have just as very well have gone off the cliff with rates spiking, which would have put a lot of pressure on the housing market and consumer and corporate borrowing. Remember, the Feds must keep rates down for any hopes of stabilizing the real estate market. Now, this volatility is the same type of volatility that we saw in the stock market going back to September and October of last year. And some people have asked me, is a dislocation still possible? I've said yes, very much so. Next week should be another wild ride because more debt will be auctioned off and the Fed will be buying some treasuries. Now, if this blows up in Ben Bernanke's face, rising rates will hurt the housing market even more. Now, speaking of the housing market, let's take a quick look. The mortgage crisis is spreading and hitting new heights. Borrowers with good credit now make up the largest share of foreclosures as job losses and pay cuts take their toll. A record 12% of homeowners with a mortgage were behind on their payments in the first quarter. And the trend is predicted to continue until the end of next year, about 6 months after unemployment is expected to peak. Now, these borrowers that I'm talking about are borrowers with top-notch credit scores and credit histories. Now, banks always account for a certain percentage of bad loans. I can tell you this, prime mortgages are probably about 2% of bad loans. That's the norm. There is no way any bank would expect 12%. That is 1 out of every 8 loans going bad. Now, that is absolutely unreal. Now, risky adjustable rate loans made to borrowers with bad credit remains a significant factor in foreclosure. Today, almost half of all subprime adjustable rate mortgages are past due or in foreclosure. In Florida, New Jersey, and in New York, the number is above 55%. Now, last month in California, we had 96,000 foreclosures. Now, that's 1 every 20 seconds. Okay, commercial real estate is next. Thousands of commercial mortgages valued at hundreds of billions of dollars are approaching a renewal date. By some estimates, 2 out of every 3 will no longer meet the original loan conditions and won't be able to refinance. And with prices of commercial properties expecting to plunge, a vicious cycle may unfold, much as it did in the nation's housing market. This whole thing could implode by this summer. So how does this play out and what does it mean? Well, it means the banks are toast. I don't see how they will survive. The amount of capital that they need will be staggering. How can they earn their way out? It's impossible. The government will have to deal with this crisis next. Now, I'm watching this very carefully and getting ready to bet the farm against a couple of banks that are heavily exposed to mortgages here in California. I don't see how they will survive. Honestly, it's going to be catastrophic. And speaking of California, things here are bad and about to get worse. We have a $24 billion budget deficit, and tax revenues have fallen off a cliff, and cuts will be absolutely brutal. So anyway, this is just a short market update. And again, I'm going to be shooting a video tomorrow about how I've been preparing for all of this, and I think you'll find it very educational and very informative. So I thank you again for watching, and I look forward to your comments.